Hi, this short video is to help us explore the spreadsheet that's necessary for the townhome cash flow. So what I've done here is I've highlighted in the description of the Where to Live project the important stuff for the townhome. So in this case, it talks about the cost of the townhome is $470,000. The homeowners association dues are $300 a month, and it will increase 1% a year. And you also have some expenses related to the townhome. In this case, we have the dishwasher oven range will be $3,600, and that'll have to be replaced every 10 years. And then also we need to replace the water heater after 10 years. Has the costs associated with that. And then the mortgage is that you're going to put 20% down from the 470,000, and it says it's a 30-year fixed rate mortgage at 2.875%. In addition, the property tax is going to be 1.2% per year of the assessed value. So the assessed value is what you paid for it, plus that assessed value is going to increase 2% a year, just continually assessed value. And that's related to the taxes, the laws regarding property tax. And just know the income tax is 28% there. And then homeowners insurance will be $75 a month for the townhome. And then at year 20, you're going to sell it at double the price that you paid for it, and then you need to include the capital gains tax, which is 15%. So that's kind of an overview, and you have all these things, but I wanted to go through the townhome cash flow to show you how I organized it. So I have the year 1 through 20, because we're going to own it for 20 years, and then I put the actual year there. The income, which was stated before, that it would be $80,000 a year, and then it would increase 5% a year up through 15 years, and then it would be flat. That's the same in both cases. The mortgage payment, which we calculated here on the mortgage payment for the townhome, the calculation of that mortgage payment, I think it's here. Is this where we calculated payment? Nope, this one. This mortgage payment was calculated based on the cost of the townhome, 20% down, so the loan is $365, the difference in those, and then the interest rate and the number of years gave us the payment amount, the monthly payment, which was $560,000, $1,560,000, and $1,560 per month. And then in order to get the annual, we just multiplied all that by 12. You can see here I multiplied by this monthly amount by 12, and that just is going to be the same. And then the principal paid, we did that on this monthly here, where we had the principal amount paid, which is actually the monthly interest minus the principal. So if you look at the other video about how to calculate the loan payments, you'll see how we got this. But this is the remaining balance in the loan. So this goes 20 years here. So at the end of the time period, we have a loan balance of $162,000 out of the original 376,000. So in the cash flow statements, what I have here is I have the mortgage payments, the property tax, which is calculated in the annual mortgage payment slide, but you don't actually have to do it there, but that's where it is. We look at the wait, where is it? Sorry about that. The property tax is in the monthly townhome times 1.2%. So it looks at the assessed value that we had, what we paid for it, times 1.2%. That's an annual rate. And the monthly rate is divided by 12, but we don't have to do that. And then what I'm going to do is I'm going to increase that amount by 2%. So I'm going to take this value, multiply it by the previous one by 2%, and I just increase that property tax along. The homeowners association fees are the insurance, homeowners insurance is $75 times 12, and then it increases every 5 years by 10%. The HOA fees are the 300 times 12, and that increases by 1% a year. Then these are the other costs that we have that were spelled out related to replacement of utilities, and then utilities and the water heater. So the before tax cash flow then is going to be the income minus the mortgage payment, minus the property tax, minus the insurance, minus HOA, minus other costs. So that's going to be your before tax cash flow. Then we deduct from that the mortgage interest rate we pay, the interest expense we pay, because that's what's deductible for tax purposes. We also want to deduct the property tax from that. So the taxable income is going to be the income tax, the annual income, minus these two values. So that's how much we'll get taxed on. So then the taxes are 28%. So we're just going to do a straight 28% on those taxes. The after-tax cash flow is going to be the before-tax cash flow minus the taxes, minus any kind of asset disposal or that we have at the end of the time period. So this this is the after-tax cash flow, and then the investments. This is where we put the down payment, and then the after-tax cash flow after investments is going to be the after-tax cash flow minus that. And then we take the present worth factor, which we're going to use this 8%, and we're going to calculate this present worth factor for all of the years. This value times that gives us the present worth of these cash flows. And then we add them all up here, and that's the present worth. I know that was a lot, but I hope that helps a little bit in your understanding of it.